What's up, everyone? This is Anthony Pompliano. Most of you know me as Pomp. You're listening to Off the Chain, simply the best podcast in crypto. Let's kick this thing off. Kyle Bass is the founder and chief investment officer of Hayman Capital. In this conversation, we discuss the housing short trade that made him famous, what it was like to buy millions of dollars of nickels, what he believes is happening in Hong Kong today, what the structural issues that he sees in the global economy are, and what Kyle's thoughts are on Bitcoin and its future. I really enjoyed this conversation, and I hope you do as well. Before we kick off this podcast, first a word from our sponsor, BlockFi. As many of you know, crypto investors store their digital assets on exchanges or in cold storage for long-term safekeeping. However, this strategy doesn't help them grow their investment holdings or build overall wealth. With the new BlockFi interest account, users can now securely store their Bitcoin or Ether at BlockFi and receive 6% annual interest paid monthly in cryptocurrency. 6% is an absurdly high rate. It's the best rate in the industry. I highly suggest you go check out blockfi.com/pomp. Again, that's blockfi.com/pomp to sign up and start earning crypto today.
Anthony Pompliano is a partner at Morgan Creek Digital. All opinions expressed by Pomp or his guests on this podcast are solely their opinions and do not reflect the opinions of Morgan Creek Digital or Morgan Creek Capital Management. You should not treat any opinion expressed by Pomp as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. This podcast is for informational purposes only.
All right, guys, bang, bang. I am here with Kyle. We were actually sitting in his home in Dallas, Texas. So thank you so much for taking time out of your day to do this.
You're welcome.
Absolutely. People want to know a lot.
Yeah.
You've kind of done a bunch of stuff in your life. Maybe let's just start, if you can give us kind of 30 seconds on how you describe your background. I'll ask you then about a couple of the trades you guys have made previously, and then we can get into some of the more recent stuff.
How I describe my background. I think that I'm just intellectually curious and unfortunately like to be a contrarian where it makes sense. And I think that what we do as a firm, what I look to do is be a global event-driven investor. And I know that encompasses a lot of different asset classes, a lot of different environments and ideas, but that's typically what we do as a firm.
Got it. And so one of those big trades obviously was the housing situation in 2007, 2008. Mm-hmm. Maybe talk a little bit about kind of what you guys did there, what led you to kind of become interested.
Yeah, there was an aha moment when back then, if you remember, China had ascended to the WTO in 2001, and really in earnest, call it 2003, 2004, you saw our Rust Belt, the United States, start to really hemorrhage jobs. So there were significant job losses across, call it the industrial belt of the U.S. And at that point in time, that was still a market. If you remember 03, 04, 05, that was when you had, Greenspan had taken rates down to 1%. He'd left them there probably too long, and we had our massive housing boom. And then we started raising rates in really June of 04, and you had housing continue to do better because instead of a housing downturn in 04, what you saw was Wall Street had built this machine of securitization. They just decided to dip down lower and lower in the credit spectrum. So rates didn't really affect the total number of homes being sold. And in the Rust Belt itself, you actually saw job losses and home price declines. Mm. And so I was on a call at one point in time in 2006, early 06, with an analyst or a mortgage-backed securities analyst at Royal Bank of Scotland. And I was trying to isolate securitizations that had larger concentrations in the Rust Belt, mm-hmm. because we knew you were seeing home price declines and job losses, and historically that was the telltale signal of a bad securitized asset. And I was running through a model with him, and I said, so what if home prices across the U.S. just go flat for a year? Because he had sent me a model of up 6, up 7, up 8. And I said, but what about zero? And he says, yeah, that doesn't happen. So we don't even have it in our models. And I said, what if just hypothetically, maybe there was just a zero? Forget a home price decline. And he said, well, in a zero, these securitizations would lose 3 to 6% of their assets. And I said, but that would wipe out the triple Ps. He says, yeah, but that's not going to happen. And that was that moment where you thought, if you could find a decent concentration of a securitization in the Rust Belt, but also we thought housing was going to flatten out and God forbid it go down, it was going to wipe out a lot of these securitizations. But that's what happened. That was the aha moment.
Got it.
Was just being curious.
And so in that situation, you guys have capital that you can go and deploy into that situation. You have to go convince investors.
I launched my fund in really February of 2006, our global macro fund, February of 2006 with $33 million. And a chunk of that was my savings. Whatever. I was one of the biggest investors. And so when we came up, once I had ironed out that idea, that was called June of 2006, I took that idea to investors and launched a subprime only vehicle in September of 2016.
Got it. Of 2006.
Oh, sorry, 2006.
Got it. Okay. And then, and so as you go through that, were there the psychology of you put an idea together, right? You go and you pitch investors, you get some that are interested, and then you kind of sit and wait because things really didn't get nasty until 2007, 2008?
No,
or
what was interesting about that is things were getting nasty in 2006.
Got it. So you pretty much saw right away, hey, we're most likely right.
On the 23rd day of every month, the performance report of all of the loans within these securitizations is released. It's released in text, it's released to these data services, and you get to see how they're performing. And their performance was constantly deteriorating. And in fact, we launched our fund in September of 2006 on I can't remember the day, September 16th or 17th. People said, why don't you just wait until October 1st? I said, I can't wait for another performance report because what if the market falls apart? It's doing so poorly right now. Early payment defaults were spiking. That means people that don't even pay their first mortgage payment.
Wow.
Those were spiking in call it third quarter of 2006. EPDs were spiking. Performance was deteriorating. They were all still rated AAA, for all intents and purposes. And we would have meetings and say, why aren't they falling apart right now? So if you remember, February of 2007 was the first time that there was a break in the bottom end of the structure of these securitizations. And then from February to June of 2007, they actually rallied back up. Thank God, because we were trying to get $5 billion invested, and I needed every sucker I could find. And unfortunately, we didn't get the whole $5 billion invested.
Yeah,
it kind of dried up.
It's funny because one constant across a lot of investors who have these more macro approaches to the world, they come up with a single idea, they have a lot of conviction in it. You hear the same thing over and over again. I knew it was going to happen, but I didn't want it to happen immediately because I wanted to get more money into the trade, right? And so hearing that is pretty interesting. Another trade that you're well known for, I think at this point, is the nickels. So you took a bunch of money and you bought nickels. Explain a little bit about what the logic there was.
That actually wasn't quote a trade, and it had nothing to do with investor capital. It was, in seeing what world governments did, including our own, in response to the 2007-8 crisis, we all know what happened, right? Central bank balance sheets went out of control. And so whether it was the US or Europe or Japan or China, you name it, they grew their central bank balance sheets like weeds. And I was trying to explain that to my kids. And in talking to my kids, I was explaining to them that this is the new path. This is what's going to happen. There is no going back. There is no return to a gold standard or return to some fixed asset standard. It's not going to happen. It can't happen because then growth gets cut off and you have all kinds of bankruptcies, and we know that just can't happen. So in talking to the kids about it, I said, so rates are at zero. There's no opportunity cost. You're not earning anything in your bank account. So why wouldn't you go own the actual metals, right? And basically copper and nickel and nickels. And at the time, copper and nickel together was worth about 6 cents, and nickels were worth 5 cents. So where in the world is there a free perpetual option on metal? Well, in the marketplace, you actually have to pay a pretty significant price to buy a 2-year copper option or a nickel option. And in taking down nickels, you got it for free. So I was just teaching my kids that I'd rather own a bunch of nickels than have my money sitting in the bank while the Federal Reserve prints it away. And again, that was just a teaching moment. It had nothing to do with, kind of call it true capitalism or return on investment.
Yeah, it's pretty cool that you're having those conversations so early in their lives, right, where they can understand it.
I'll tell you a story I've never told before.
Okay. He's saying this with a grin on his face, so this one's going to be good.
This was a fun one. In 2008, early 08, before Bear Stearns, went down, I was driving in my car. My son was in the car, and at that time, he was 8 years old. All right, so he's almost 20. Yeah, so roughly 8 years old, and I had just taught him in a year before that my son never spent his earnings. Whatever he did, chores around the house or did a job for a neighbor or something, he would always save his money, always saved it. And he would save it in cash in his box. And I explained to him this concept of interest, and that if you put it with a bank, the government insures it, so you're not going to lose it, and you earn interest. And so the closest bank to our house at the time was a WAMU. And if you remember, WAMU's entire balance sheet was option arms. Okay, so I was talking with a good friend of mine in New York, and I was on the phone, and we were talking about which banks were safe and which banks were unsafe. If you remember, we were thinking about where to put your money. When we were all wondering which bank was actually going to be solvent with their levered balance sheets. And he says, what about WAMU? And I said, well, look, WAMU's all option arms. I said, they are done. I don't care that Bob Steele's their new CEO. WAMU is finished. I said, they're going to be bankrupt. And the government will probably have to take them over. And I go through all this with my good friend who's another asset manager. And I hung up, and my son in the back seat says, so Dad, the WAMU you were just talking about, he says, is that the one where my money is? And I said, yes, Sam, but you have nothing to worry about. Nothing to worry about. He says, Dad, I want my money out. So we went, I took him to the bank. We went in, we filled out the deposit, with the withdrawal request for his entire credit balance of whatever it was, $850, which at the time was a lot of money. And this very nice lady was at the counter, and she said, oh, you were so cute, but what are you going to go spend this on? Are you going to buy, a Nintendo or Sony PlayStation? What are you going to spend it on? And he says, no, ma'am, your bank's going out of business, and I need my money before it goes out of business. He said, my dad says that you're going to be broke. And you
an 8-year-old.
Seen the look on her face. And my son and I it's so funny, we were just driving yesterday by this bank who's no longer a WAMU. And we were both reminiscing about that time when he went in and convinced the teller that she was in real trouble. And anyway, it was a good time.
The 8-year-old knew better than the people who worked there.
Yeah, so it's good that my son was listening because, anyway, it's a funny story that hasn't ever been told.
For sure. No, I appreciate that. Hong Kong, you've been quite vocal about a lot of the structural problems going on there. Maybe describe a little bit about the pegging and kind of the challenges that you saw. And it's now probably 2-3 years ago at this point when you really started to pay attention, and then what's transpired in your mind in terms of really proving that you guys were spot on with the analysis.
Yeah, well, I think when you try to understand this idea of two countries and one system, or really how they say it, one country and two systems. And I think that...
And just so those that don't know, Kyle's talking about China and Hong Kong. They're technically...
they're a special administrative region of China, i.e., Great Britain ruled Hong Kong for a long time, right? They basically took over Hong Kong in the Opium Wars, and then took over the rest of the outer area of Hong Kong, Kowloon, and the rest, in the Second Opium War. And I think that... they basically signed a 99-year lease, and then Deng Xiaoping went to Thatcher and said, "We want it back." And that was in really the late 70s and early 80s. These conversations started to be had, and if you remember, as those conversations were being had, after Hong Kong was ruled by Britain for so long, and had a rule of law, and had a judiciary, an economic system, and a legislative system that again had order and had law, a lot of money was invested there. And if you look back to 1980, call it from 79 to 83, so the currency's been pegged since 83 to the dollar. But from 79 to 83, the Hong Kong dollar lost 50% of its value versus both the British pound and the US dollar, because everyone was worried that if China were to get Hong Kong back, that there would be the heavy hand of China's Communist Party and economic policies that are, let's say, substandard and no autonomy, and therefore no one would leave their money there. So the first currency panic that really happened there was as a result of China's potential takeover. Fast forward, so they peg in 83 to the dollar because it was literally out of control. And in 84 was when Thatcher signed the deal with Deng Xiaoping of China, and they basically signed what they called the British Sino 1984 Joint Declaration of 1984, which stipulated that the Brits were going to hand back Hong Kong to the Chinese in 97, and that was going to be a 50-year deal, i.e. China was going to abide by this agreement. The agreement is to remain autonomous, i.e. one country, two systems, one country being China. China is going to own them both, but it's going to allow it to maintain its autonomy in both in the economy, the judiciary, and the legislature. And so that agreement was signed by both parties. There is no adjudicative, let's say, review of that deal, meaning if one side breaks it, there is no de-escalation, there's no negotiation. Either it's an agreement or it's not, and that's kind of where we find ourselves today. But there's an interesting fun fact also. As we headed into the handoff of Hong Kong back to Chinese in 97, what happened? The Asian financial crisis happened, right? And so the handoff was July 1st, 1997. And when did the Thai baht break its peg?
I think it's the day after, right?
The very next day. That's not coincidental. The money started running out of Southeast Asia, primarily Hong Kong, because it was its financial center due to the British law. And the money started running. And so they had an existential crisis. Many currencies broke pegs. Hong Kong back then held the peg. But as a result, they suffered a massive depression. Real estate dropped 75% in value. Imagine real estate dropping 75% in value, what that would do to a banking system and an economy.
Now, how do we get from like that mass panic and all the concern, money running, et cetera, to more stability over the last, call it almost 20 years, right? 20 years or so.
So China basically decided to stand behind its commitment in the 1984 Sino-British Joint Declaration, and also the U.S. Hong Kong Policy Act of 92, where we decided to treat Hong Kong as its own separate sovereign territory as long as China lived up to its end of the agreement and didn't infringe on the autonomy of Hong Kong in any of those three areas. We re-review, we as a country re-underwrite that agreement every year. The State Department writes a letter to the President and says either we believe Hong Kong sufficiently autonomous or not. The Brits actually re-underwrite it twice a year. So you can go to Parliament and read what the British, essentially State Department, writes to their Parliament. And what you've seen so think about this, the last 10 years of Hong Kong's life has been the best 10 years that they'll ever see. Reason being, they're pegged to the US economy. They're pegged to our central bank. We took rates to 0 in 2008, and their largest trading partner, China, went to the gas pedal. They had the golden years of Hong Kong. They had free money, and they had a real estate market that went berserk, went 600-700% 10 years. Imagine that. Now they're the most expensive real estate market in the world. They have the most leverage of any developed economy in the world. Their private sector credit to GDP is 300%. The US and Japan's a little less than 150. Okay, and you know how levered Japan is and how levered the US is.
So it's literally double.
Yeah, double. and double at a very low base. So when their rates start moving up, it hamstrings their entire economy. Again, they've had a real estate market go to the moon. And then they also have one of the most levered banking systems in the world. They're 900% of GDP in their banking system assets. Again, so when losses just start to trickle through, their bank equity disappears.
Yep.
Right? In the U.S. financial crisis, we all in, including off-balance sheet financing, were about 1.75x. They're 9x.
Wow.
Just to put things into perspective. Today we're 1x. Right? We are, and if you include Fannie and Freddie, we're call it 1.5.
Okay. And then describe, so this idea of pegging the Hong Kong dollar to the US dollar, and what you originally saw as to why the peg can't possibly work for two separate economies.
Yeah, just imagine a rigid financial relationship. Rigid, meaning there's a peg at a level for 36 years. Okay? For 10, 20 years, you think about back in 83, as the U.S. went, the world went. I.e., if we grew, the rest of the world grew with us, and if we declined, the rest of the world had a small recession with us. We were the economic engine of the world. Today, one could argue that China is, since the financial crisis, pulled the world out of the world financial crisis. I.e., their economic growth kind of pulled the world, and they still run about a $13 trillion economy, and we have about a $20 trillion economy. So we're still almost twice as big as they are, but they've grown a lot. And so I think that what you see happening now is Hong Kong is now completely dependent upon China for their GDP. It's service growth. So it's real estate services, financial services, legal, accounting. That is Hong Kong's, and travel. That's Hong Kong's economy. It used to be they were an exporter and re-exporter of goods for southern China. Now they're a service-based economy facing China. So if our rates go down while China's economy blows up in a good way, then Hong Kong has a great 10 years. If our rates start to move up and China continues to slow down, that is the death knell for Hong Kong. And now that's what we saw. The other most interesting part of that is you could sell forward Hong Kong dollars and they'd pay you while you had it sold. I.e., it was a positive carry transaction.
Yeah.
So if you were Japanese or if you're European and you have negative rates, wouldn't it be more fun to have a positive carry position in the most levered developed economy in the world? And if you're in Hong Kong and you have free convertibility between US dollars and Hong Kong dollars, you'd actually have to be a fool to hold the Hong Kong dollar, right? Because of all of these reasons I give you, you don't even have to agree with me.
Yep.
You actually just earn more money holding dollars.
For sure.
So why not hold a dollar?
And so as you guys see this coming together, right, you went out and literally said, hey, we believe that this is going to be a problem. Here's why. And what we've seen transpire over the last 2 to 3 years, I think just now people in the Western world who aren't specifically focused on Hong Kong are starting to see it creep into mainstream media coverage.
I wouldn't say creep. It was on the front page of every paper for the last few weeks.
For the last few weeks.
The protests.
Now,
and this is,
at the beginning of this,
secondary to our idea.
Yeah. So at the beginning of the year, I think if you asked kind of a normal American, they would have no clue that there was any trouble on the horizon in Hong Kong.
That's right.
Probably the last 4 to 6 weeks now. It's really every single day they see the videos, of the white gang, beating people. They see the photos of people with kind of blood running down their faces, and it's. I think most Americans would say something's going on. I haven't really been paying attention, but there's kind of unrest, right? From somebody who's been paying attention for years now, kind of describe what's transpired over the last 6 months and why it's all coming to a head now.
So there's a much longer situation going on with the relationship between China and Hong Kong and what China's trying to do to further control Hong Kong's economy. Hong Kong is the epicenter of where China raises dollars in the world. And it's important to understand China. How many times have you talked about China's economy and you say, well, I think they're going to have a recession, or I think they're going to do better, and someone says, yeah, but they're China, they can do whatever they want to do. So in China, the Chinese government controls everything. They control the printing press, they control price levels, they control the police, and they control the narrative. Now they control the people with Orwellian social credit score. They literally control everything. So you and I can sit here and say, but they can do whatever they want. They can recap their banks in RMB. They can print more RMB. They can, again, do whatever they want. I actually agree with that. And if they had a closed system and they didn't have to trade with the rest of the world, if they were not resource rich, then we probably wouldn't be doing anything here. But what's important is China has to interface with the rest of the world, and the rest of the world won't take their shitty currency. I don't know if I can say that on here.
You can say whatever you want.
No one's going to take monopoly money, right? And so it's important to realize that China's FX reserve balance is their working capital. It is what they're desperately short energy. They're the largest importer of crude oil in the world now. They're desperately short food. They're desperately short raw materials, right? They are resource poor. And so you see China using Belt and Road around the world to basically lend themselves into acquiring big assets, whether it's port assets or mines or roads or airports or governments. They're lending their way into resource-rich areas for the long run. And so for them to buy any resources, they have to spend dollars, euros, yen, or pounds, mostly dollars. So they must maintain this dollar balance. So it's important to realize that China is running a massive fiscal deficit, 10% of GDP or more. Just think about that. When the US breaks 3% of GDP, Congress goes berserk. China's running a 10% of GDP fiscal deficit, and when you include their local government financing. And they're running a current account that we think will go negative from now on. It has never been negative before. It went negative just recently, and we think it's going to stay negative, and we don't have enough time to get into that. But their dollar balances are going to start deteriorating. So how do they maintain a positive dollar balance to keep growing their economy? Well, they get people like MSCI to make the China weighting in the index go from 5% to 20% in just a couple of years, which is happening right now, right? They get someone in the Bloomberg Ag Index, Ag Bond Index, the old Lehman Brothers Bond Index, to add them to that index. And money flows into them that way. Oh, and then they open up their capital markets for U.S. investors to buy more of their banks. Right after they wreck their banks, they say, the spider says to the fly, oh, you can own more of our banks now. Right? But in the end, they need dollars of serious dollar flow. So Hong Kong is the epicenter where they raise those dollars. Alibaba says, we want to raise $20 billion in a spot secondary in Hong Kong. Well, of course they do, because money's fungible. Alibaba's run by the Chinese government, and they're just going to sell as many shares as they can to bring dollars into China Inc. So Hong Kong is functionally very important to them from a financial perspective. And China's economy has enabled them to be more aggressive on the geopolitical front. Right? They take the money they get in and they build aircraft carriers, and they build missile systems, and they build hypersonic this and that they steal from us, but they need dollars to build these things. And so Hong Kong's really important. What China's did this February, they got Carrie Lam, the CEO of Hong Kong, to introduce a bill kind of quietly that stipulates that if China determines anyone's a criminal in Hong Kong, and that's China's sole determination, that they can extradite them and basically hold them accountable in China.
So they can take them out of Hong Kong, bring them to China, and
extrajudicially. Meaning, if they say, Anthony, you came to Beijing, and there's no statute of limitations. So if you came to Beijing 20 years ago, you stepped foot there, and they said, you raped a girl. And if the if the conviction would carry more than a 7-year penalty, then you're extradited. No questions asked in the Hong Kong court. And as you know, the Chinese use political persuasion, and their legal system is a kangaroo court. And so there are 85,000 Americans that live in Hong Kong. Anyone that literally lands in Hong Kong on a stopover, if you're going to land in Singapore or Hong Kong, in the past you probably say, I don't care which one it is. But now you're going to say, I'm never going to land in Hong Kong. If China can grab me, I'm going to go to Singapore. And so it's important to realize that the citizens of Hong Kong realize that there's no statute of limitations, and now they're subject to we call it the whims of the Chinese Communist Party.
It basically completely violates the British-Chinese agreement.
And the U.S.-Chinese agreement, the U.S.-Hong Kong Policy Act of 92. And so, i.e., Hong Kong must remain sufficiently autonomous. And what you're seeing today, what you're seeing in this extradition bill, is their autonomy's gone. It's just a question of time for when China sends in the PLA, their army, through Shenzhen into Hong Kong, and then it's over. So any hope that the Hong Kong people have had for a true democracy, maintain a rule of law, and be the center that they've always hoped it was going to be, that's been extinguished.
So I want to touch on one more thing before we get to more global macro and Bitcoin stuff. But I saw you tweeting about recently there's these videos of basically gangs of men running into train stations all dressed in white. And what I've gathered is basically the police are not participating in protecting the citizens. Correct. There's these gangs that are beating up, it's the teachers, it's the journalists, it's the protesters, it's all this stuff. And what it looks like is those gangs will allow somebody, most likely the Chinese government, to step in and say, we must protect the people. And therefore they will then send in the army, the police, whoever to kind of take control.
Yeah, it's what's interesting is if you follow this on a daily basis and you know people throughout Hong Kong, both in their government and in just the citizenship, what you see is the initial protests, whether it was the lawyers, the 3,000 or so lawyers that protested the extradition bill silently walking to Parliament, or the 1 million protesters, or the 2 million that showed up on the biggest day. 2 million people, only 7.5 million people in Hong Kong. Imagine if a quarter of the U.S. population ever protested anything. Right, that would be what,
crazy.
70 million people or more. That would be just on an order of magnitude. You can't understand. It's hard to.
Where do you put them all?
Yeah, I mean, just think 2 million people. But the 2 million person protest, if you saw the pictures and the videos that people took, it was perfectly. It was perfectly clean. It was perfectly non-violent, and then post those marches, Carrie Lam said, despite the fact that 2 of 7.5 million stood outside in 97-degree weather for an entire day to protest this bill, I'm going to go ahead and put it through. And then people went a little bit more crazy. But you've just recently seen these triads, these gang members come in the white shirts with bamboo poles, iron poles, and even machetes, and they beat the living hell out of some of the protesters. And I mean, it looked like the Rodney King beating in the United States. I haven't seen anything like that on video in a long time. And the Hong Kong riot police are in the periphery, turn around and walk the other way, while their own citizens get beaten almost to death. And so you see that the police are complicit. And in fact, there were many photos of the police with the rioters beforehand, almost like game planning. And you I don't know if you've seen these photos.
I have not, no.
So collaborating. So the police are in on it. And the police are run by the government, and the government is really run by China and the pro-Beijingers. And I think it's important to realize that, in Xinjiang, where the Chinese have at least 1 million, and U.S. intelligence believes it's 3 million, political prisoners based upon their religious preference, it's starting to sound like a real problem, like a Hitler-type problem, because the UK just determined they were live organ harvesting from these people. And they're just political prisoners because of their religious preference. So those things don't make it into the mainstream media because you can't take pictures. The Chinese will never let that happen. Xi's existential nightmare is Hong Kong, because it was technically free and democratic before, and everyone has smartphones and cameras and internet. So all of these pictures circulate on the internet, and so everything he's doing to incite violence. So we believe that the Chinese government and the Chinese army have brought in the triads and the gangs to beat the people, to create violence so that China can come in and rescue Hong Kong from these violent times with their own army. And then, again, that snuffs out any autonomy. So that is what's going to happen next. Watch what happens. That's what will happen next.
In one sentence, what is the way that you guys plan to, from a asset management perspective, like how do you play all that happening?
Yeah, I just think the common denominator is this peg between the Hong Kong currency and the U.S. currency, and we think that Hong Kong needs a peg, but we think that peg will be to the Chinese currency or a basket of Southeast Asian currencies where their economies move in tandem, and not with the United States.
Got it. Let's switch gears real quick to more the global economy, right? In terms of, I think there's a lot of people who say there's warning signs, whether it's the inverted yield curves or other kind of alarms going off that there's likely to be an economic downturn at some point, in the short term, whether that's 6 months, 12 months, 36 months, whatever. How do you think about the central bank reaction to that? And then as part of that, talk me through your framework for evaluating something like gold or Bitcoin.
That's a pretty big open-ended question there, Anthony. Look, we think that you're going to see a slowdown in Southeast Asia. You're already seeing it. China's growing at the slowest rate it's grown at in the last 35 years, and that's what they're reporting. So we all know that when the books are in the oven, you're going to see something even better than is real. So we think they're growing GDP 2 or 3%. In fact, last year it could have been flat. And so if Southeast Asia is going to have a 0 GDP year or small recession, then the rest of the world will grow a little less. So again, I don't expect a 2008 style, I don't know where to put my money crisis. I think you're going to see a shallow recession in the developed world, a deeper recession in the Asian world, or the Southeast Asian world. And what does that mean, right? That means that the central banks will just print more, right? You're seeing today, we're expecting at the end of this month, we're here in July of 2019, part of the market believes we're going to have a 50 bip cut. The other cadre believes we'll have a quarter point cut. We're at 3.7% unemployment. We're still at emergency levels of rates, and we're talking about cutting rates again. So,
and is it the QE and printing of money is really just because the central banks only have two tools of cutting rates or printing money, or is it something else that you think they're kind of tied to?
No, I think that in the event that you have a small recession, and if you're near the zero lower bound, you have very few tools.
It's just the only other thing
in the shed. You look at Japan. Okay, people say, well, how long can this go on? The Tea Partiers, and by the way, I'm technically a Tea Partier from the perspective of looking at financial economics, but people say, how long can it go on? And you can say, well, if this is the tactic, then it can go on almost forever. In a nominal world, the Bank of Japan owns 77% of every ETF in Japan.
Wow.
They are a top 10 holder in 4 of the largest companies of Japan. Just think about that. They've been buying stocks for a very long time, and they're going to keep buying stocks. They own over 100% of the bonds of Japan, of Japan Inc. They've monetized 100% of GDP of their deficit. And I asked one of Japan's top central bankers at a breakfast that was private, and I said, you say you don't monetize your debt, and yet you own over 110% of GDP of your debt at the central bank. I said, what do you call that? And he looked at me and he says, Kyle-san, we're only monetizing our debt when the market tells us we're monetizing our debt. But that is how they think about it. And so that is the path. So what I'm convinced of is the path. The path is simple.
Okay.
They'll cut rates to 0. Maybe some will even go, NERP. I think NERP decimates the banks, and as you see, Europe's all their zombie banks. As Deutsche Bank just found a magical 80 billion euro hole. All of these banks have big holes. The U.S. recapped its banks. Europe's banks are zombie banks, and China's banks are now levered more than any bank has ever been levered in world history in nominal, call it RMB, but not in terms of capital. But all of these banks, there's really nowhere to go other than to print.
Yeah, and then I know that you guys have looked at Bitcoin specifically over some period of time. Just what's the framework that you've used to look at it, and then kind of what are some of the things that have kept you guys from doing anything there?
Yeah, I think that
we spent a lot of time beforehand talking about this, so I'm leading him.
We'll cover it again. The bottom line is, as the digital asset class began its growth, so back when Bitcoin very specifically was $2,300, is when we were looking at this, saying this is going to be an asset class, and I use Bitcoin in kind of a collective term. It's crypto Bitcoin, not speaking of the ICO securities that are crazy. Let's just talk about pure crypto assets. I think that we try to get comfortable with the fact we are a fiduciary, we are regulated, we are governed by the regulatory bodies that oversee fiduciary capital management. And we couldn't find what we deem to be a qualified custodian. And a qualified custodian needs to be, call it, stipulated by the Securities and Exchange Commission and the Fed, and all these people need to approve, as you probably know, who is holding the public key, who's holding the private key. We as an asset manager can't ever take possession of our assets. For instance, when we own, if and when you own gold, you can take delivery of gold into a bona fide COMEX warehouse that is a qualified custodian. You can actually take physical possession, you just can't put your hands on it. It becomes illegal for you as a fiduciary to put your hands on it. And so that was the problem that we ran into in hiring as many different legal teams as we could hire, and in this evolution of asset prices, evolution of this asset class made it difficult for us. And so we began it at $2,300 a Bitcoin, and now we stopped at about $4,000 a Bitcoin on its way to whatever it went to,
20,000,
and God only knows where it is today. But then the argument becomes, as you and I discussed a little earlier, more philosophical from the perspective of putting yourself in a central banker's seat, or let's say more importantly, someone that's running the government or the treasury or the presidency of any sovereign nation. When you think about what your sovereign identity is and what you can control and can't control, this is that ideological difference between, call it a libertarian and a sovereign government. And I think you probably know from reading anything I've written that I fall more into the libertarian camp, and I'm a fiscal conservative. However, when I think about the rules-based system and the system that's been developed the way it's been developed, and I mentioned to you earlier today, I think that this asset class can grow to a number. I don't know what that number is, and today I actually don't know what the whole asset class is worth. You probably 350 billion. Could it go to $1 trillion? Probably. But I'll bet when it gets to $1 trillion, it becomes a much larger problem, and it will require almost affirmative determinations by governments that it's either okay or not okay with them. And you could say, well, it's too bad if it's not okay. I'm going to own it, and it's decentralized, and I can own it in my Japanese account, I can own it in this account, I can own it in this account. Well, the U.S. government, for instance, has a number of different things that they require you to file with your tax return every year, that if you don't declare it, it's a felony. And the last thing you want to do is go to jail. And so I believe that there are structural things that are going to happen when it becomes more functionally relevant and more widely adopted. But I do believe it's going to be more relevant and more adopted. So I don't know where that really puts me other than in a philosophical bind.
Well, I think just talking to you today, it's you understand the philosophical arguments behind it. You have a pretty good understanding of the technical, how it works, why it has value in certain cases, all that.
And I'm a huge proponent of the blockchain. I get it. I understand this concept of the immediacy and the perfect archive. Let's say the perfect historical archive of the blockchain. I buy that hook, line, and sinker.
I think your argument is a rational one in the sense of if it actually works, you run into an obstacle. Now the question is it a roadblock where literally you can't get through it because the government just clamps down on it, or is it more of a speed bump, right? And it's kind of, hey, that they got to do some work, and then they come out and they say, okay, it's fine in this sandbox or within these rules. But I think that even the last couple of weeks where we've seen the Senate, the Congress, literally the chairman of the Federal Reserve, the Treasury Secretary, the president, they've all discussed Bitcoin, cryptocurrency, Facebook's Libra, etc. They're not asleep at the wheel, right? No. It's not like they're not paying attention. It's just a question of how included do they want to be, or how active do they want to be versus kind of letting it just grow on its own before they step in.
I think, as you mentioned earlier, I think Facebook is this has become the devil to both sides of the aisle. And the one thing that Facebook doesn't have on you, they have your pictures, they have your identity, they know who all your friends are, they know what you care about, they know a lot about you. They don't have your personal financial data and your social security number. And guess what? Libra's going to get all of that. And so whether they say it's altruistic or whether they say it's just a business proposition, for Facebook to have that much data, that much power, I think that's why you're seeing this pushback. And again, this gets to my point of, can a cryptocurrency ever gain that much power in its own right as a challenger to a hegemonic system? And I believe its own success will be its own problem. And so you're just starting to see some of that. Do I think this is the top? I wouldn't possibly call it top here. Do I think it has more room to run? Probably. Yes. But do I think that that's going to be a speed bump or a roadblock? If I were betting, I would bet it's more of a roadblock than a speed bump. But there'll be some along the way that are speed bumps. What I'm telling you is the obstacles will get larger and larger the more successful it becomes.
Yeah, and I think also which jurisdiction you're talking about is a whole nother thing, right? There's some jurisdictions that will say, bring it all.
Yeah, there are great places for it. You mentioned Argentina. These troubled third world countries, look, Iran, Venezuela, all of these absolute horrible communist, socialist dictatorships that have ended so greatly. I mean, this is what everybody wants, right? Everyone wants there to be a perfect socialistic communist government where everyone has the same amount of money and everything's going to work great and everyone has college. And okay, we all know that's never going to work. Go talk to the people that have tried it. But those places, sorry, there's a little political jump there, but I think those places show you that there is a need to be able to save yourself from hyperinflation, from your government getting it wrong, right?
Absolutely.
And I think that is what's fueling a number of the players today to think, I need 1% of my assets there, 50 bips, or I need 4 or 5%. I need some number that's not going to break me if I'm wrong, but some number that if the government gets out of control with its spending and its policies, then I have some store of value, right? I mean, this is the whole argument, and I buy that argument. If I put my Treasury Secretary hat on, it's a problem for me.
Yeah, it's you're one of the few people I've talked to that understand the asset, the benefit, the risk, right? And yet still can rationally think about the outside forces that don't care about, kind of the fundamentals, if you will, to some degree, right? And those two things are separate, right? And frankly, the stronger the fundamentals, the more your concerns about some of the other stuff becomes real. So, listen, I really appreciate you taking all the time to do this. It's been a lot of fun. I promised him that we would end on time, so he can go do some family stuff. But we could talk for hours. So thank you so much, and we'll have to do it again.
It's a pleasure. Absolutely. Thank you.
All right, guys, thanks so much for listening to that podcast. Before I let you go, one more word from our sponsor, BlockFi. Their new interest account allows you to securely deposit your Bitcoin or Ether at BlockFi and receive 6% annual interest paid monthly in cryptocurrency. This rate actually compounds, so you receive a 6.2% APY, which is very attractive given the alternatives. So you can actually take your Bitcoin, you can deposit it with BlockFi, and get paid an interest rate of 6% in return. Go check out blockfi.com/pomp. Again, blockfi.com/pomp to sign up and start earning interest on your crypto today. Hey everyone, Pomp here. If you like this episode of Off the Chain and want to help us take crypto to the top of the Apple, Spotify, and other podcast charts, please do us a favor and rate, review, and subscribe. To review, simply go to the Off the Chain homepage, scroll down until you see the 5 blank stars. Taking 15 seconds to fill those stars in and leave a quick review goes a long way in helping us take the entire crypto ecosystem to the top of the charts. I appreciate you listening and see you next time on Off the Chain.